Usually, the stock market seems like this clean, simple binary. You buy, you sell, and the ticker just flashes red or green.
Right, it feels completely instantaneous.
Exactly. The transaction is fully visible, totally frictionless. But the moment you step past the user interface of your brokerage app and get into the actual plumbing of the financial system,
Yeah.
all that visibility completely vanishes.
Oh, absolutely. It's a total black box for most people.
Right. You enter this shadow landscape of capital flows, collateral swaps, and overnight lending. And that's what keeps the entire machine from just, well, grinding to a halt.
Which is exactly why this specific deep dive is so critical for you to hear. We are looking at the ultimate back-end infrastructure of the Japanese market.
Yeah, the average investor never, ever interacts with them directly.
Never. But your portfolio fundamentally relies on them to clear and settle trades without causing a massive liquidity bottleneck.
So, welcome to this deep dive into the Japanese stock market. Today, we are tearing down the walls of that ultimate shadow warehouse. We're talking about Japan Securities Finance Co., Ltd.
Or JSF, as they're much better known.
Right, JSF. And we are bypassing the standard corporate summaries today to look directly at the actual mechanics of their balance sheet.
Because, while wholesale liquidity provision sounds like dry academic financial plumbing, the macro shifts hitting their business model right now are huge.
Oh, completely. The hard numbers they are posting make this an absolute masterclass in corporate adaptation. So I'm going to break that down for you.
And we are definitely bringing a heavy dose of data-driven skepticism to this analysis, too.
As always.
Yeah, we're dissecting how global interest rate differentials, cross-border collateral demand, and these strict regulatory cages are violently reshaping their revenue engine.
Right, because this isn't just about what JSF does on paper. It's about the financial physics of how they generate yield in a market that is fundamentally transforming right before our eyes.
So true. Let's pull apart their true identity first, though, because JSF really defies typical corporate categorizations.
Yeah, if you look at their filings, it's a bit confusing. You see a trust banking arm, Neshoken Trust Bank, and then this real estate leasing subsidiary called Nyon Building Co.
Right, but if we apply the 80-20 rule, those are just peripheral assets. Well over 80% of their operational focus and their capital deployment belongs to the core securities finance business.
The technical distinction here is just paramount. They aren't just another generic financial services firm,
Not at all. JSF is literally the sole securities finance company in Japan operating under a specific license from the Prime Minister.
Wait, the Prime Minister, like directly?
Yeah, it's a very specific mandated monopoly. Their explicit legal mandate under the Financial Instruments and Exchange Act is to supply liquidity.
Meaning massive injections of both cash and stock directly to brokerages, right?
Exactly. It's to facilitate standardized margin trading across the board.
Okay, so think of them as the central bank for retail brokers. Like if we look at the institutional scale of margin requirements, a major sell-off can trigger millions of margin calls simultaneously.
Right, the market tanks. And suddenly brokers face this immense immediate cash deficit.
And they don't just have billions of yen sitting in a backroom vault waiting to bridge that gap.
Yeah, of course not.
So JSF acts as the ultimate systemic shock absorber for you and me. They extend wholesale cash backed by a hyper-specific collateral framework just to keep the domestic market liquid.
And you really see the scale of that warehouse when you consider the concept of market dependency. Being a government licensed monopoly in a specialized niche is incredibly defensive.
Assuming that specific niche is actually growing, sure.
Right. But JSF historically carried a massive structural vulnerability. Because their core mandate was exclusively tied to margin lending, their balance sheet was heavily correlated to the retail investors' appetite for leverage.
Ah, I see. So if the domestic market dipped or if trading volumes just sort of consolidated, their revenue experienced a highly correlated plunge.
Precisely. They essentially held a monopoly on a roller coaster that they had absolutely zero ability to steer.
Which is terrifying. That represents a total lack of operational control for a company of this massive size.
It does. But that sets the stage for one of the most compelling dramas of adaptation in modern Japanese finance. They recognized that this margin lending dependency was a critical point of failure.
So rather than just accepting that cyclicality, they pivoted. They leverage their existing, highly secure clearing infrastructure to build an entirely new revenue engine.
The broader security finance business, or SF.
Yeah, and the mechanics of this pivot are just fascinating. They didn't abandon their prime minister mandate. They just expanded the definition of their plumbing, basically.
They started executing sophisticated repo transactions, lending bonds, and acting as a primary counterparty for massive institutional nodes.
Right, so instead of just funneling cash to domestic brokers for retail margin, they started facilitating collateralized loans for global hedge funds and asset managers.
And the operational translation of that pivot is no joke. It requires building entirely new trading desks, integrating advanced risk-weighting models, and taking on really complex institutional counterparty risk.
But the data resulting from that is staggering.
Wow, it's huge. If we look at the baseline in 2012, their security finance business revenue was sitting at a modest 6.6 billion yen.
Okay.
Fast forward to the recent data, and that specific segment has exploded to over 28 billion yen.
Let's just visualize that math for a second. They essentially bolted a new multi-billion yen business onto their legacy chassis. Going from 6.6 billion to 28 billion isn't just an organic, incremental bump.
No, not at all. It represents a fundamental rewiring of their corporate DNA. They successfully transitioned from a domestic margin utility into a global repo and bond lending powerhouse.
And building that institutional repo desk naturally forced them to look beyond Japan's borders,
Right.
which completely alters their global macro exposure.
Exactly. Global institutions operate with this insatiable requirement for high-quality liquid assets, or HQLA.
Because of Basel III banking regulations, right? Global banks have to hold massive reserves of pristine collateral to secure their trading books.
You nailed it. And Japanese government bonds, JGBs, are the absolute gold standard for that collateral requirement.
They carry essentially zero risk weight for domestic banks, and global funds use them extensively in cross-border collateral swaps.
And JSF identified the friction point in that global supply chain. You have a localized supply of JGBs in Tokyo and aggressive, continuous demand from funds in London or New York.
So JSF just stepped directly into the middle of that spread.
Exactly. They take the domestic supply, manage the haircuts and collateral pricing, and lend those assets out to non-residents.
Wow. And this bridging mechanism dramatically expanded their cross-border loan portfolio, which of course introduces a massive variable into their formula, the Bank of Japan's shifting monetary policy.
Right, because for decades, JSF operated in a zero or even negative interest rate environment.
But with domestic rates finally creeping upward, the mechanics of their core business change entirely.
Yeah, the BOJ's policy shift functions as a pure interest rate engine for JSF. As domestic rates climb, the broader market's funding demand increases.
And because JSF sits right at the center of the liquidity web, the spread they capture between their cost of borrowing and the yield on their lending actually widens.
Exactly. A rising domestic rate environment mathematically enhances their baseline profitability.
Okay, wait, isn't that a bit optimistic given the situation in the U.S.?
Uh-huh.
I mean, banking purely on a widening domestic spread ignores the volatility of the other side of the trade.
That is a very fair point.
Because if they're facilitating cross-border transactions and holding a portfolio of foreign currency securities to capture higher overseas yields, they are absorbing massive currency risk.
Yes, they are.
So what happens to their net yield when central banks in the U.S. and Europe hold rates high or unexpectedly pivot?
Well, we can simulate that exact macro headwind by looking at the mechanics of hedging costs. When JSF holds foreign currency assets, they use currency swaps to neutralize the exchange rate volatility.
Right. But those swaps aren't free.
Far from it. The cost is directly tied to the differential between short-term rates. If U.S. short-term rates remain elevated while Japanese rates are comparatively lower, the cost to borrow dollars in the swap market skyrockets.
Ah, I see. So the higher yield they hunt for in, say, U.S. Treasuries or European debt gets entirely consumed by the mathematical fiction of hedging the currency risk.
Precisely the dynamic at play. When you track U.S. and German long-term rates against the cost to hedge USD and EUR, the data clearly illustrates how elevated hedge costs eat directly into JSF's foreign securities portfolio returns.
Oh, wow. So it acts as a powerful drag coefficient on their overseas profitability.
Exactly.
So we know they're absorbing massive global demand for JGBs while simultaneously battling these aggressive hedging headwinds.
Right.
The critical question for you as an investor is, how effectively is management pricing that friction?
Right. Let's trace that global spread directly into their operating revenue and look under the hood at the actual financial causal chain.
Yeah, let's look at the engine room.
The translation into their EPS and ROE is remarkably definitive. When we examine the financial targets and data leading into the fiscal year ending March 2026, the sheer velocity of their revenue generation becomes apparent.
Okay, hit us with the numbers.
Operating revenue surged to over 59.4 billion yen. That represents an 18.4% year-over-year expansion.
And the flow through to the bottom line.
Net income spiked by nearly 30%, crossing the 10.3 billion yen threshold.
Let's just isolate that 30% spike for a second. A 30% jump in net income for a heavily regulated Prime Minister licensed financial utility is virtually unheard of.
It really is.
They didn't achieve that by simply tightening operational expenses or, issuing a few more margin loans.
No, they aggressively releveraged their balance sheet toward higher velocity repo transactions, all while maintaining their mandated capital buffers.
Which fundamentally transformed their return profile. And this brings us to the metric that institutional investors watch obsessively: return on equity.
Yeah, the narrative arc of their ROE is arguably the most important signal in this entire deep dive.
Completely. Because just a few years ago, JSF was languishing with an ROE hovering around 2.6%. They were the textbook definition of a sleepy, overcapitalized utility stock that value traps are made of.
But now they have blasted past 7.4%, and management is actively telegraphing that they are, quote, conscious of the 8% level moving forward.
And that 8% figure isn't just pulled out of thin air, is it?
Not at all. In the context of Japanese corporate governance, specifically the Ito Review guidelines, 8% is the magic threshold.
Right. It's the number that proves a company is generating genuine capital efficiency rather than just slowly destroying shareholder value.
Exactly. By targeting 8%, management is directly answering the demands of the Tokyo Stock Exchange.
And the broader market has finally priced in that structural change. Their price-to-book ratio, the PDR, has decisively broken through the critical 1.0 barrier. It's currently sitting at 1.10.
Let's explain the mechanics of what breaking a 1.0 PBR actually means for a legacy Japanese financial institution.
Yeah, please do.
Below 1.0, the market is essentially saying the company is worth more dead than alive.
Ouch. Meaning that liquidating their assets would yield more than letting management actually run the business.
Right. So breaking 1.0 them means the market has fundamentally capitulated on that value trap narrative.
Investors now actually believe JSF's future earnings power, driven by this expanded securities finance engine, justifies a premium over their liquidation value.
It's a massive psychological and mathematical shift. They've effectively added a whole new tier of structural profitability.
And their total shareholder return is dramatically outpacing the broader TUDAC-X index as a result.
But, record profits and expanding multiples force us to scrutinize the next link in the chain, capital allocation.
Right, because generating surplus cash is only half the battle. How management deploys that cash determines the long-term survival of the firm.
Are they hoarding it to build an unnecessary fortress balance sheet, or are they actually optimizing it?
So what's the reality of their capital strategy outlined in their latest commitments?
Well, JSF has pledged a staggering 100% total return ratio through fiscal year 2025.
Wait, 100%?
Yes. That means every single yen of net profit generated is being returned to shareholders via a strict combination of dividend payouts and aggressive share buybacks.
Okay, I have to play the skeptic here again. A 100% payout ratio often signals a management team that is completely run out of growth ideas.
It can, yeah.
So is this a genuine optimization of their balance sheet, or is this just a temporary sugar high? Are they just throwing cash at activist investors to buy peace because they fundamentally don't know how to innovate any further?
It's a fair question. But if you look strictly at the mechanics of their legal structure, it's actually the most capital-efficient move they can possibly execute.
How so?
You have to evaluate them within the regulatory cage of the Financial Instruments and Exchange Act. Because they are classified as systemic market infrastructure, they face severe legal restrictions on how they can actually deploy capital.
Ah, right. The government is never going to allow the ultimate shock absorber of the stock market to take their mountain of cash and aggressively acquire, like, an AI startup or pivot into speculative commercial real estate.
Exactly. They are legally quarantined from high-risk, high-reward external ventures.
So their hands are tied.
Mostly.
Yeah.
Therefore, holding excess capital on the balance sheet simply depresses their ROE. By executing massive share buybacks, they systematically shrink their equity base, which is the denominator in the ROE equation.
It's pure financial physics. You shrink the equity base while maintaining the new, higher net income from the repo business, and your return on equity mathematically accelerates toward that 8% target.
Exactly. It's a forced discipline dictated by their regulatory constraints, but it is incredibly lucrative for current shareholders.
Right, but we cannot allow the expanding multiples and the aggressive buybacks to mask the inherent vulnerabilities here.
No, as data-driven analysts, we must constantly probe the foundation for systemic cracks.
So what is the blind spot here? If they are a government-licensed monopoly with a newly diversified revenue engine and a highly optimized capital allocation strategy, what actually breaks the machine?
The blind spot is embedded in the very definition of their role as the ultimate infrastructure provider.
Okay.
It's the Lehman shock scar. In 2008, an unprecedented financial tail risk caused JSF to post a net loss on a consolidated basis.
Wow, a net loss.
Yeah. Because they serve as the ultimate counterparty for a massive portion of the market's wholesale liquidity, a systemic shock is basically their kryptonite.
Right. If the collateral they hold, even the highly rated assets, suddenly experiences a catastrophic liquidity freeze, or if multiple major brokerages default simultaneously, the plumbing backs up entirely.
Because at the end of the chain, they're the ones legally mandated to hold the bag. They absorb the toxicity so the broader retail market doesn't collapse.
Man, that's heavy.
Furthermore, that strict government licensing we just praised for enforcing capital discipline, it acts as a lethal double-edged sword. Let's assume the landscape of retail investing experiences a total paradigm shift. If a new technology completely disintermediates traditional margin trading, or if sudden punitive regulations kill the profitability of the repo market, JSF cannot simply pivot.
Because their regulatory cage prevents them from aggressively diversifying into entirely unrelated, unregulated business lines.
Exactly. They're fundamentally changed to the mechanics of securities finance.
So they've adapted beautifully within the confines of their cage building out the institutional security finance business to survive the volatility of retail margin. But they're still undeniably inside that cage.
Spot on. If the water level drops globally, they cannot simply walk away from their mandate.
That is a phenomenal conceptualization of their risk profile. We started this deep dive talking about visibility, pulling back the curtain on the hidden capital flows of the Japanese stock market.
We really went deep into the plumbing today.
We did. We've traced how JSF evolved from a highly vulnerable monoline margin lender into a sophisticated global repo powerhouse, aggressively re-leveraging their balance sheet and blasting through profitability targets along the way.
And we've mapped the complex macrophysics they navigate daily, balancing the tailwinds of a rising domestic interest rate environment against the severe drag of cross-border hedging costs.
But the true test of a systemic utility isn't what they've built over the last decade, is it? It's how they handle the next fundamental shift in market mechanics.
Absolutely.
So I want to leave you with an entirely different existential threat to consider. We are seeing a massive global push toward faster settlement times right now.
Oh, definitely. The U.S. recently moved to T+1 settlement.
Exactly. So if the global financial system eventually adopts T+0, meaning instantaneous, real-time gross settlement utilizing blockchain or distributed ledger technology, the inherent latency that creates the need for massive margin loans and overnight collateral warehousing shrinks to zero.
That's a massive if, but a very real threat to their core model.
Right. If trades settle at the speed of light, does the market still need a mega warehouse for wholesale liquidity? And if that latency vanishes, how does a highly regulated, prime minister-licensed plumbing company reinvent itself for a market that no longer requires pipes?
It's the ultimate three-year survival question.
Something for you to think about as you watch domestic rates shift and global collateral demand fluctuate. Keep questioning the numbers.